sometimes it doesn't discount the very obvious things. Like it's very strange. It's like a strange psychological phenomenon. It's almost like willful ignorance. Like I'm just gonna pretend this thing goes away. I'm just gonna pretend this doesn't exist until I can't ignore it anymore.
If you look back at the biggest spreads here, which is what this is, right? You're talking about the great financial crisis, right? Or you're seeing a huge spike right around the COVID situation, or in April, right, where the financial market seemed like it was going to cease. All of those had VIX of 40 plus or even higher, right? That's where you get this really big premium. So it's very unusual to get this big vol premium when the VIX is just at 25.
Welcome to the Excess Returns Weekly Recap. I'm Jack Forehand, joined by my good friend Matt Ziegler. And Matt, I think it's fair to say the market has got a little exciting this week, maybe?
The market got exciting. Special shout out, 4 words of the week, which are two-word phrases. I feel like my entire week is revolved around inference inflection, which I don't know if has that been in your life too, and dynamic hedging. I feel like all the excess returns conversations had dynamic hedging in them somewhere or some type of options part. And this inference inflection came out of the Jensen Huang NVIDIA presentation. And it's just like, I've been jokingly like fitting it into work meetings just because I feel like it's my latest buzzword of choice.
Well, dynamic hedging is a great theme. And first of all, I didn't even know that was a Taleb book, dynamic hedging. I had read some of the other ones. I read Fooled by Randomness, but I did not know about that. But it's fitting because basically we've got a lot going on in the market and we've got 2 different ways to look at it, plus some evergreen stuff this week. So we've got Jared Dillian looking at it from a macro perspective. We've got Brent Kochuba looking at it from an options and flows perspective. And then we're going to add in a little timeless biotech investing on top of it.
Timeless bioteching. I think my favorite part about this from D.A. Wallach, who's I love interlopers between businesses, and he checks those boxes with his music background and everything else. But then on top of that, for a biotech interview, that was the most like value investor conversation with like options math and everything else layered in. That was one of the most educational investing conversations I have had in a long time. I actually feel like I learned stuff from talking to DA.
It was really good. We'll highlight some clips here, but I also would highly recommend people watch it. I mean, obviously I know the YouTube algorithm wants like the world is ending and stuff on its for people to click on stuff, but this was actually a really excellent episode. And it also got me, Matt, as you know, I'm not a man of the arts by any stretch, but I did go listen to his band. It is quite good. It was very good. Yeah.
I keep telling people like there's a few songs you probably know and you just don't realize what this is, but this is high concept pop art in the best way. So really, really cool that he's transitioned from music to Spotify to venture now into biotech and actually gets it. But, going to smart places like Harvard probably helps.
And I also don't often look at our guests when I'm sharing clips on Twitter and be like, oh, this guy's got 1 million followers. And I'm like, wow. Because he basically has 1 million followers on Twitter, which is pretty impressive.
Perks of being a rock star. Where you want to start? Where are you kicking us off with clips today?
Yeah, so let's start off. I mean, the war is kind of what everyone's talking about right now, so we should probably start there. And you covered it on a bunch of different angles with Jared Dillian. But the first was this idea of when a war is coming up, do markets price this properly? So here's Jared talking about that.
The Ukraine war wasn't priced in. Like, it was the weirdest thing in the world. Like, Russia put about, $100 billion worth of military equipment on the border, and everyone is like sleepwalking through this. They're like, they're not going to invade. And prices didn't move until they actually invaded, even though there was plenty of warning. Same thing with Iran. We've been saying, Trump has been agitating for this for a long time. We knew it was coming for weeks.
June 2025 was when the stuff started.
Yeah.
Like we're in March.
So it's weird because the market is a fantastic discounting machine, and it seems to discount some things better than others. And sometimes it doesn't discount the very obvious things. Like it's very strange. It's like a strange psychological phenomenon. It's almost like willful ignorance. Like I'm just going to pretend this thing goes away. I'm just going to pretend this doesn't exist until I can't ignore it anymore. And then, it gets priced in. So, structurally bad. I was heavily influenced by Nassim, like growing up in the markets. First of all, a lot of people don't realize this, but Fooled by Randomness is not his first book. He wrote a book called
textbook, the options one.
Dynamic Hedging.
Yeah.
Yeah, he wrote Dynamic Hedging, and I read Dynamic Hedging when it came out, although I didn't understand much of it. And I read Fooled by Randomness in 2001, and he thoroughly convinced me about the virtues of being net long options, right? I'm an option buyer, you know, professionally, in my fund, in my personal account. Like, I generally don't sell options as a general rule, not even really covered calls. So, I don't, especially in the stock market where you have so much gap risk, in individual stocks. Like, I don't want to be in a situation where I'm short calls on something and it gets taken out, or I'm short puts on something and there's like an earnings report and it gaps down 20%.
So this is an interesting debate here in terms of on one side, you've got the efficient market hypothesis that basically the market's pricing whatever's happening. But Jared's point was like a lot of times with these wars, when we're leading up to them, like the market doesn't price it that efficiently or doesn't price that it's going to happen. And then it does happen and things change really quickly.
This is what I love about Jared. And part of it is just the overall neurodivergent like sense of the world that he has on some weird cat psychic level, I guess is probably the best way to put it. But it's this awareness that I see something bad happening or potentially happening in the world, and I see that it's underappreciated, and that creates my first opportunity. And then my second opportunity is when it's already being like appreciated, if it's not being like, it's like the over-expected expectation. He's always looking for those little like rate of change adjustments, which is so different from the perspective of like looking for like the one long big move. He's like, oh, there's a catalyst as these expectations get normalized as of what's there. I hadn't really thought about this with war before. Like, had you thought about this specifically with political conflicts like this?
Not exactly. But what I think is interesting too is like I would argue there is maybe more. The market does price it properly more than he thinks. But the reason I would say that is because it's really hard to price binary events.
Right.
Like there's either going to be a war or there's not going to be a war. So the market is probably pricing in some probability of that. But in the end, it's not going to be that probability that's going to be realized. It's going to be yes or no. And so like the market's not going to completely price in the war is going to happen unless the war has already happened. And so that's an opportunity for people like Jared who might think the war is going to happen, because if you think that, it's not going to be completely priced in. So there's an opportunity to take advantage of it.
Yeah. And fascinating on both sides of that trade. Like if it's going to happen, then you look for places where you can own something that benefits from the underpriced side of the event actually occurring. Like you're going to your point, you're going to make your own probabilistic assumptions about what could happen and see like where you could profit from that. And then on the other side of it too, once it's known, people are likely going to overreact. So then you're going to turn around and think about like, how do I play this down on the other side? The Peloton story that he tells midway through this episode is like a perfect non-war example of like, here's the assumption on the front end. Here's the assumption on the back end. Here's where the mismatches occur. And to your point, especially like binary outcomes or just complete changes of states, it makes some weird stuff and not your typical value investor conversation.
Yeah, and we're not done with the binary outcomes, by the way, with this war. Like there's all kinds of things, and that's what makes these things so hard for investors. Like things could change any day. Like we could decide to blow up Karg Island tomorrow. And that changes everything about, or we could just completely back off tomorrow. Although I could argue like the taco is going to be a little bit harder right now than it was last time. We could do that. And so this will come up in the conversation with Brent Kochuba as well. Like this idea of it's just very hard to price these things when you've got these major events that are either going to be yes or no. And there are all of these things floating out there.
And that concept right there, it's hard to price them. And that difficulty in pricing them creates some opportunities. Take us to this Brent clip, because this is one of the reasons I love talking to option makers. I love talking to our market makers in options who actually have to deal with this. And I'm so glad you did one of these Brent episodes this month.
Yeah. And what's interesting is like people always say price is truth, but that's definitely true. But what's also truth is what people are actually doing with their money. And so you hear all kinds of stories in the media about here, this is happening and people are doing this or that. Like Brent sees options flows. Brent sees what's actually happening behind the scenes. And although I don't trade options, and we joked in the podcast, like I don't even know what half of these options trades even are. Like for me as a long-term investor, it's interesting to see what's going on behind the scenes because it explains a lot of stuff I'm seeing in front of my eyes. So this first one with Brent is this idea of realized volatility versus the VIX. And something interesting is happening right now as people price this war risk in terms of that. So here's Brent talking about that.
I was trying to put into context just how significant this was. So if you look back at the spread between the VIX, so you just take the VIX index and then you take realized vol. Realized vol just tells us how much the market's been moving the S&P over the last month. And you compare those two levels, which you can directly, right? The current spread, or at least the spread when I made this chart, was 10. I think it's widened out a little bit. 10 is a very large number. We were as high as 12, and you're talking about top 15 spreads that we've seen over the last 10 years, right? So it's very significant. But what's weird about this is that the VIX is only at 22. So if you look back at the biggest spreads here, which is what this is, right? You're talking about the great financial crisis, right? Or you're seeing a huge spike right around the COVID situation, or in April, right, where the financial market seemed like it was going to cease. All of those had VIX of 40 plus or even higher, right? That's where you get this really big premium. So it's very unusual to get this big vol premium when the VIX is just at 25. So what is that saying? People are hedged, but the underlying market's just not moving very much. And so what's unusual here is not the hedging, I would argue, not the VIX 22. What's more unusual is the fact that we're not realizing any real market movement. And my concern with this is that I think at some point we finally get that 2, 3, 4, 5% equity market drawdown, vol starts to realize, and then suddenly the VIX just goes, okay, great. And then it goes to 40, right? So you're just going to get, and this is the jump risk that I think can happen. And as we remove these options positions with expiration, I think it frees up the market to have that realized vol move, right? And then suddenly we have that VIX spike that, again, shows up on a Wikipedia and makes everyone really sit forward in their chair and go, uh-oh, what just happened?
Do you know when we see these historically? I mean, do they typically resolve by realized volatility moving towards the VIX versus the other way?
Normally what happens is you have a VIX goes to 50, right, or 60, and then you get a policy intervention. If you think about in COVID, Powell announced a bunch of cash comes off, or Trump with the Liberation Day tweet, or in this situation, if vol goes really crazy, okay, Iran deal solved, then we're going to, quantitative easing, whatever it may be, right? And so what then happens is the VIX gets slammed because you can sell forward vol, but you can't sell realized vol, right? Because it already happened. So then you'll see is the spread will go sharply the other way, as you can see like here, right, in COVID, where the spread goes negative because realized vol remains high, but people start to sell vol, like implied vol. You can't sell VIX directly, but you get the deal. You short the VIX, you sell puts, whatever. Implied vol crashes, and then realized vol still high. It takes a little time for that realized window to come in.
So this is interesting just in general, because if you think about, so this is what happens when you get these risk events. So what happens first is people start buying puts. People start hedging the event. And so what happens then is you start to see implied volatility, or the VIX, go up, but realized volatility can't catch up. And so what Brent was showing in that clip is that's a 1 month trailing realized volatility, which is what, 22 days or whatever there is in a month. So 1 day of a volatility spike is not going to change that much. So you always see this in these events. You saw it in COVID. You see it in these other events. The VIX starts to spike. Implied volatility starts to spike. People start to panic, but you don't see it yet in realized volatility. And so Brent was talking about that. Like, we've gotten to the 90th percentile right now in terms of the difference between the VIX and actual realized volatility.
Honest question. How delta neutral are you right now? How delta neutral is the Jag forehand portfolio?
Oh, Matt, I'm neutral in all parts of life, as you know. I'm a very delta neutral kind of guy.
Perfect answer. Maybe you can explain this. Maybe this is a sidebar conversation I'm going to have with Brent behind the scenes, or I'll call Chris Abdelmasih on this one too. Like, the idea here is that they're hedged, but they haven't moved the underlying yet. That's the disconnect between like where the VIX is versus the realized.
Yeah, the idea is if you want to hedge something really quick, like that's what you're going to do. You're going to go to options. Like, you're not going to start, and also there's tax reasons and stuff like that. You're probably not going to start like liquidating your underlying positions. So what happens is when you get this spike in implied volatility, it kind of tells you people are going to the options market to hedge versus people are, selling their actual positions. So it's just interesting because it becomes the VIX is a fear gauge. I mean, that's what people call it. And so you just see this when you get these events. You see this VIX spike, and it can sometimes indicate hedging in terms of what people are worried about for the future. And it's just interesting as a long-term investor to know, all right, people are getting really worried. It's spiking. Like, what does that mean going forward?
Yeah, I think it's really interesting to look at this. And I also appreciate, and Brent says this over and over again in the conversations, is, we're looking at like day-to-day changes here. He's talking about like, if these moves in the underlying happen over a few days, here's where you get the giant VIX spike. It's important to be able to look at the short-term reality of this as it compares to some of the longer-term value, because this stuff is just going to reset every single day, no matter what.
Right, that's right. So Brent always talks on the podcast about how he deals in 30-day increments. And so, like, for someone like me, I don't deal in 30-day increments. Like, I'm holding positions for the long term. So for me, it becomes what I think this stuff is really good at, and we'll explain it more as we do his future clips. But this idea of explaining what I'm seeing in front of my eyes. So, like, I'm not making changes in my portfolio based on what's going on in the option space, but like, you see these spikes in the market, you see these weird moves, and you're like, CNBC's trying to come up with some news story to explain what's going on, and that's not really what's going on. Like, it just makes me feel more comfortable that I can explain what's going on because I know what's going on behind the scenes and I can see Brent's work.
Yeah, I'll forever go back to I think it was the Kevin Weir story about an index rebalance, or like some roll option or futures roll thing. And he was like, what the heck happened in the markets? And it was like, oh, like Carl was sick and his wife was sick and he had to take his kid to soccer practice. So we pushed the roll to Monday from Friday. I see those CNBC headlines go by and I just think, where are the other stories? Work like Brent's helps remind me, especially in client conversations where it's like, well, what moved today? It's like, okay, if the technical people are all describing a weird technical thing that happened, I want that in my brain too, not just what the headlines are saying, move the market in isolation on a given Thursday.
So this next clip gets into what I think is one of the most interesting things going on in markets right now, which is we had a Fed that was probably with a cutting bias, was kind of holding for now. You get an oil shock, and oil shocks are so interesting from a macroeconomic perspective, but now you've got a situation where what is the Fed going to do? And so before I give my opinion on that, let's see what Jared Dillian had.
The Fed is doing a very normie thing here. First of all, like, we're recording this about an hour after the latest FOMC, and the rates were unchanged. Mirren dissented, which is expected. There was really nothing in the directive to write home about. And then in the presser, like, Powell says, if we don't make progress on inflation, there will be no rate cuts. And stocks melted down and bonds melted down and the dollar ripped. And I was kind of expecting a hawkish meeting. So I'll get back to what I said originally about this normie view of the markets, like, because, the ECB does this too. Everybody is talking about the ECB hiking. Like, conventional wisdom is that oil prices going up cause inflation, which is totally understandable because oil prices feed into transportation costs and everything else and increases the cost of everything. But there's a side to this that I think people don't fully understand, which is that they also are deflationary in the sense that they cause demand destruction, right? So the price of gasoline is not perfectly inelastic. If the price of gasoline goes up, people will buy less. Not a lot less, but a little bit less. And if the price of food goes up, people will buy less. So there is some elasticity there. And when it comes to more discretionary purchases like apparel or electronics or stuff like that, which oil prices also feed into because of transportation costs, there's much more elasticity. So I'm not entirely convinced that oil going to $150 is going to unleash this inflationary spiral, which is what I think most central bankers think, So is Powell right to be hawkish here? I actually kind of don't think so. Now, it doesn't really matter what I think he should do. What matters is what he will do. I don't know if he's going to be able to or will want to hike rates with Trump looking over his shoulder. But we're pricing in one rate cut this year and one in 2027, and that's it. And those are probably going to get priced out. The yield curve is flattening here. The yield curve's gone, 2s10s have gone from 70 bips to 50 bips. It's probably going to continue to flatten. So
do you think is part of that the idea that a rising oil price ultimately reduces consumption and weakens the consumer?
yes.
Therefore, like, you don't want to run into a credit event by being extremely hawkish, but the right response is to kind of like wait and see how damaging that price rise is, that inflationary price rise. Because it's not like it's rising because there's increased demand. It's rising because, oh crap, the price of this basic input is throttling us.
Yes, and getting back to what you said about the Fed causing the path of least embarrassment, like, the Fed is not going to cut rates with oil at 100 because that would seem to be insane and that would subject them to a lot of criticism, right? So they're not going to do something like that. Like they're going to do the conservative thing. They're going to wait and see, or they're going to, agitate about hiking rates. But they're not going to take a risk and say, we're going to cut rates.
I love calling the Fed normie. Let the record
Yeah.
show. I think
is great.
that is amazing. Back to your, self-depreciating comments of being delta neutral all the time or being the most neutral. Like the Fed is the ultimate normie institution, and this idea that they follow the path of least embarrassment, that they just don't want to get egg on their face, so they're going to be cautious and conservative, I think is an insanely useful framing. So that out of the way.
By the way, I almost used path of least embarrassment on the thumbnail. I thought about it.
Fantastic line. It's a fantastic.
It's probably not charged enough, and also you run into a problem with long words on the thumbnail because they don't fit. But I know no one needs to know about that. But that is the truth of building thumbnails. But anyway, back to this Fed and oil thing. Like this is really interesting because oil shocks are like one of the hardest things for the Fed to deal with. Because on one hand, this is going to reflect in short-term inflation. Like inflation's going up because of this, and we've already kind of seen that in some of the producer stuff behind the scenes. But on the other hand, like high oil is not good for the economy. Like it's going to pull spending from other areas. It's not good like for the economy. So like they've got this short-term problem. They've got this long-term problem. Like they were already kind of in a no man's land and they didn't know what to do. Like I'm just happy I'm not part of the Fed because this is a really hard thing to try to figure out what to do with.
It's an impossible thing to figure out what to do and this is probably where they do nothing. So and Jared brought it up, it's right now over this year and next year, we have the expectation of basically 25 basis point cuts or whatever currently priced in. Those probably go away as like the cone of uncertainty more or less like widens. And it's just like, well, we're not going to do anything because in the face of the uncertainty, we're just not going to budge. Because if they go hawkish and they tighten credit, if you haven't heard, some people are concerned about credit bubble stuff and will not stop talking about it. Not saying that's wrong. I'm just saying there's a lot of worries in credit land right now. So it's like if you tighten, you might exacerbate that problem. And the reality is like if you cut into this to try to help, you got a higher inflation print. There's going to be demand destruction on the other side of this. This is just a whole part of the consumer economy is going to get the crap kicked out of them, like the higher these prices last. But the Fed doesn't have a way to control for this.
They're going to have to do nothing. Jared had the great quote, like the Fed can't cut into $100 oil, which is true. Like they can't. There's really nothing they can do here. They're just going to have to wait this out and see how it plays out. Like there's too many problems either way. Like you said, the Fed is kind of like me. Like they don't want to ruffle feathers. They want to kind of so they're just going to go down the middle right now. They're going to probably make comments one way or the other at meetings, but they're probably going to do nothing until this plays out a little bit more.
It's going to be really interesting to watch. And it's going to be interesting to watch. And we're going to touch on this in a couple of the other clips too, where what this means for your fixed income side of your portfolio, what it means for all sorts of the details that we're all wrestling with.
So back to D.A. Wallach, because this was a great like piece on biotech and just how biotech operates. And like, this is really a masterclass in what goes on behind the scenes. And I loved his idea of thinking about this as a bag of options. So here's him talking about that.
So the typical biotech company in its early stages is not selling any product commercially. It's a company that exists to try and get new drugs through a highly regulated development process and then ultimately launched commercially. And so we can distinguish between biotech companies that are in that phase where they're not selling a product from biotech companies that are selling a product. And that latter group is going to be valued in a more traditional way based on future cash flows. The development stage biotech companies are really distinguished by the fact that there is a high degree of uncertainty that any of their products will get to the market. So let's just imagine a hypothetical biotech company. They've got 3 drugs that they want to bring to market. And each of those projects, they started a year after the one before it. So they've got these 3 staggered projects. And each of those projects is going to move through the development life cycle. It's going to probably start in what we would call the preclinical phase, which basically means that scientists are researching that drug in the petri dish, so to speak. And then they're going to do animal experiments, unfortunately, but animal experiments are still a major part of how we try to figure out whether drugs are going to be safe and effective in humans. So that's all the preclinical phase of drug development. Any project in that stage of its life has a very, very low probability of making it to the finish line. And the finish line here would be, like I said, an FDA approval and then a commercial launch. So just to give you a general orientation, a drug at that stage might have somewhere between a 5 and 10% chance of making it to the finish line. And then what will happen is the drug, if it has generated evidence that suggests it's worth spending money to take it further, will submit an application to the FDA or a different regulator in another country, and it will apply for the permission to start doing human clinical trials. The first human clinical trials, phase 1 trials, are typically going to be focused on determining whether the drug is safe. And then the phase 2 and phase 3 trials are going to be focused on trying to figure out if the drug is actually effective. And a drug, to get approved at the end of the day, has to satisfy both of those criteria. It has to be proven safe and effective in the eyes of regulators. And if it satisfies those criteria, it will get a regulatory approval, and then the company will have permission to start selling it on the market. As a drug progresses through each of these phases, the probability goes up that it's going to cross the finish line. And so you can value any one of these companies typically by basically doing a sum of the parts of the net present value of each of its programs. So this company that we're talking about that has 3 drugs, you're going to calculate the net present value of each of those projects. And in each case, you're both going to be discounting the potential future market for that program, and you're going to adjust it by the probability that those revenues will ever occur in the future. You're also going to be adjusting for the likelihood that they occur, the costs associated with developing that drug. So the valuation is going to be a sum of each program's net present value. That net present value is going to include the uncertain future revenues and the uncertain future costs that go along with that program.
This is such an interesting space, Matt. I mean, you've basically got, like, these companies have no revenue. They've got a bunch of drugs they're working on, and you've got to look at it as each drug is sort of an option. And this is, I can see how this is a place that there's alpha, because you really have to dig into all of these individual drugs and the things they're working on and all the stages of the process. And you've really got to have an edge. You've really got to know this really, really deeply.
I see this as next level sum of the parts analysis. Like, it's sum of the parts analysis with options. And I can't help but think about value guy, like sum of the parts analysis. Like, you went through your phase, right? When was your era of thinking you were going to deconstruct companies, sum of the parts, and be the next Warren Buffett? When was that era of your life?
Yeah, that happened really, really early, because I became a quant very quickly when I realized that wasn't going to happen for me. Like, I bought some pretty terrible companies like in college and realized like I cannot do that in any way. So
were you going
for
like
me,
net
I don't have
nets?
the great stories of that.
All right. Were you trying to do net nets or cigar butts, or were you actually like looking at like some of the part catalyst type things?
I mean, there was a Canadian garbage company, Matt, I have to admit. It didn't go well. I mean, the thing went bankrupt, and I was like looking at at the end of like, how is the sum of all these garbage trucks relative to like, will I get anything because of the garbage trucks, or am I going to get nothing? And it turns out I got nothing. So that's basically the best I've done on that front. You can see why I'm a quant.
I get it. Same. I've had my moments of like trying to like dabble in understanding. I love when it explains a story, and I love the idea of layering options over it with a biotech lens, the way D.A. does it. I kept flashing back as he was explaining this to me to like 2012 when the Marissa Mayer Yahoo stuff all went down. Do you remember that? Did you follow that closely? Yeah. So it's like 2012, Marissa Mayer's coming in. Yahoo's just like muddling at like 12 or 15 or somewhere in like that low teens area of like just bouncing around in price, but not going anywhere. And a bunch of these, analysts started to write about, I think Dan Loeb, some other people got involved for a while, doing the sum of the parts analysis and basically being like, here's all the unpriced things per share and how they stack up on the balance sheet. And like part of it was like, nobody seemed to remember that Yahoo had bought 40% of this then not really heard of company over in China called Alibaba. And they might be a big thing. And they own 40% of the company in like 2012 or 2013. I remember the filing where it was like Yahoo's going to sell half the position back and get some equity and get some preferreds or something else for all this stuff. And it's like, oh, okay, well, first off, you had to price it as the option that this could happen. They could monetize a piece of this. And then once it came in, it was like, well, you have an extra $3, $4 a share in cash now. And you still have the optionality of when the other 20% they own in the business eventually goes public. And starting to layer in all these probabilistic frameworks where it was like, oh, you own a call, you own this part and this value and then this call on it. Yahoo Japan. There's a bunch of other stuff. The best part being like the stub, the actual Yahoo thing that I knew them for and would make fun of them about was basically worthless. But you had all these other things that could happen over these timescales. When D.A. breaks this down for a biotech, it's like all of that logic, but now applied over almost like a venture capital framework, which gets so interesting because now every single year you have a different and reset range of probabilities and possibilities inside of this stuff that you have to now price out, map forward, and you can really see like if you can have expertise and you can get some of this right. I'm not saying it's easy, but I am saying I can see the repeatable alpha argument here. And I don't think I understood it that systematically before.
Yeah, I can too, because you have to think about this too. Like someone like me, if they're doing a sum of the parts thing, is going to look at cash flows and earnings and all that stuff. And like, there's none of any of that.
Yeah.
So you really are like, you have an edge if you have to understand this process in depth, how these things get to market, the chances at each stage. He talked about that a lot. Like, it's just really interesting to me. And I can totally see too why there's a huge edge there.
Very, very cool. Again, one of the most educational episodes in recent memory on that one. Take us, I want to go to Dillian. I want to go to this idea of correlation changes across regimes. Any thoughts on this one before we play it?
Yeah, no, I mean, I think this is something we've all been talking about since COVID because, we had this extended period of negative correlation between stocks and bonds and what happens going forward. Obviously that has changed, but whether that continues, it's just an interesting topic for everyone. So here's Jared talking about that.
After 2020, bonds became positively correlated to stocks, especially right now with the war going on. Like bonds are very correlated with stocks right now. And that really limits the use of diversification. It eliminates the diversification benefits. So what was different? What happened? What changed? Well, what changed was from 2000 to 2020, we were in an environment of declining inflation. And after 2020, we're in an environment of increasing inflation. And if you go back in history over the last 100 years, you can see that stock bond correlation worked in periods of declining inflation, and in periods of rising inflation, it did not. So one of the things I like to say about markets is that there is non-stationarity. And I don't know if that's a made up word or somebody told me once or what, but non-stationarity basically means that you're playing a game where the rules are constantly changing, right? So imagine you're playing non-stationarity chess. And I assume you know how to play chess. I'm terrible at chess, but
We could
the
have a
knight
terrible
goes
chess match at some point. That'd be great.
the knight goes up 2 spaces and over 1, and the bishops go diagonally and the rooks go horizontally and vertically. Well, what if you were playing chess and you were in the middle of a game and all of a sudden all the rules changed? So now the knights go diagonally and the bishops move like knights and the queens move like pawns in the middle of the game. And you had to adapt to these new rules, right? That is what investing is like, right? Because in a regime which might last 20 years, you get very comfortable with the rules. And it's hard to imagine an environment that could be different, right? So when the rules change and correlations break down and everything goes upside down, then you're in an environment you have to adapt very quickly. So I think adaptability is one of the greatest qualities for an investor.
What do you think? Where's the tell? What's the tell? How did we know that was true because 2020 and inflation coming back into the picture and the post-pandemic stimulus period, whatever else? Or was there some other tell that the old playbook was over with? And I'm asking that because when do we ask those questions again now?
Well, I don't think there's anything you can do to predict regime change. I don't think it's something you can predict. What I think it is that you have a portfolio, the correlations are stable, and all of a sudden they become unstable, and you have to ask yourself what is going on, and you have to adapt very quickly, right? But the problem with regime change isn't the regime change, it's that most people fail to adapt, right? They're still playing by the old rules, right? So this is a lot about being intellectually flexible, which I think is one of the top 10 or 20 qualities of an investor, right? Like to say, okay, what I used to do worked. It's not working right now. I have to do something different. And I think that's very important.
Yeah, I love this idea that I wrote it down so I could read it. Like the problem with regime change isn't regime change. The problem with regime change is people fail to adapt to regime change. And I think that's really interesting because it's very hard. The reason that happens is because it's very hard to adapt to regime change. If you've seen something for 40 years or something in terms of negative correlation stocks and bonds, and you see for a few years or something that it changes, like it's hard to know, is this going to last? And so it just makes these regime change periods one of the hardest periods to navigate for an investor.
And how it must move markets because you have people stuck in the old way who are now trying to do it. I think about this a lot. I'm thinking about this a lot right now with all the private credit stuff, with all the alt stuff, whatever else. Because I think about how the 60-40 worked really well, not just from 1981 to 2020, if not 21 or 22. And I think about post GFC, that 2010 to 2020 period. I think about how those correlations like were weak to negative, but bonds yielded zero. And that ZERP era was like the first period where I feel like in developmental in my own professional career, but it was like, especially working with pensions or working with stuff where there was a hurdle rate that we had to calculate and figure out how to meet or get over when bonds couldn't do it anymore. Post GFC, it was like, okay, well, this is where you use alts in your portfolio. This is where you do other things. And seeing all those initial private credit pitches, some of the private real estate pitches, some of the other stuff that started to creep into that world in more meaningful ways as bond alternatives. And what's interesting is like, they were interesting because they could accomplish a specific task, but they didn't actually help the average portfolio for a long time, but they like weeded their way into the system. And so now here we are in like 2026, and it's like we have this series of years where that NAV change weeded its way into the system. Not the actual reasons that those things work. It could help you out in a ZERP world, but 2022 happened. And we saw the stock bond correlation flip to positive and a bunch of people going, hey, my 60-40 lost, what did it lose that year? Like 20% or 22% or something?
Yeah, give or take. Yep.
Yeah. So it gets hammered in that year. And for a lot of people that had an allocation to say private credit or somewhere where it doesn't have to mark to reality. It's like, oh, guess what? Volatility laundering is a beautiful thing when you own it, because that was down 22. But the riskiest portion of my bond portfolio, if I'm calling it that, or my alt sleeve, didn't move at all. And like that justifies this. And you slowly see these behavior changes into these new things until they turn into a problem in the next regime. That slow moving reality is so fascinating, and it's so useful to try to just super hard to do in real time, but it's so useful to try to sit back and reflect on and go, what do I need to own in a way that's not going to get me trapped in something stupid? Because it doesn't work all the time, people. That's the lesson of this one.
This is the hardest thing about this, though, is because people want to go into these things. It's a hard thing for your own money. It's a hard thing for managing clients' money. People want to go into these things when they're working. Like, I don't know if it's still true, but the biggest inflows ever into the permanent portfolio were in like the beginning of 2009, which was the exact wrong time to be adding the permanent portfolio. And that doesn't mean the permanent portfolio is not a great long-term strategy. I think it is. But the idea is like the thing had done so well, like it lost like nothing in 2008 while the market lost 50%. So everybody wants to be in it. And the problem is these things only work when you're in them all the time. Like if you're going to try to time them, it just doesn't work. So you're right. I mean, after 2022, everybody wants to be in these things now. And I think it's a great thing to want to be in these things, but like you have to understand, like you've got to stay in them or they don't work.
You're going to end up in all these scenarios, and we'll talk about the awesome portfolio too, Jared's amended version of the permanent portfolio. But it's like, no matter what, you just end up further and further underweight stocks. So if you're in a regime where basically stocks are the things that works more than anything else, or stocks plus whatever it might be, gold or real estate or bonds or cash or whatever. Like, there's just periods where different things work. And it's back to that diversification definition. If you're diversified, you're apologizing for something you own. You hate something in your portfolio. That's the test of diversification. If you own the permanent portfolio or the 5-option awesome portfolio or some other variation, like, something sucks. But if you're way underweight stocks in one of those periods, like 2010 to 2019, you're going to underperform, and you better be comfortable with those reasons.
So this next one, we talked about Brent and why I like to follow him during times like this, because he sees what's going on behind the scenes. This one gets into the mechanics of how that actually works, what he's following. So here's Brent talking about options and the impact on the market.
People get confused oftentimes as to who counterparties are, and the idea that if, people are buying a whole bunch of AMC calls, market makers are short those calls, right? And so that should mean that if the stock goes up, market makers have to buy stock in order to hedge. I think we're all kind of aware of those type of dynamics. And then he was sort of making this joke about the fact that people will say, well, if everyone sells calls, then market makers still have to buy stock. And it was sort of just making this sort of joke, I guess, about the fact that people confuse these topics oftentimes. And the underlying theme here is that, look, when someone if you're buying calls, Jack, or selling calls, Jack, there's somebody on the other side that's doing the opposite, right? And why we care about this is because we want to know who the dynamic hedger is. Why does that matter? Because it's dynamic hedgers that impact the market. So what do I mean by that? Jack, if you buy one call and I sell you that call and we just both hold it to expiration, there's no hedging flow involved with that, then there's technically no market impact, right? We square the risk off between the two of between ourselves, and the market impact of that would be fairly mitigated. However, if you, Jack, buy a call from me, I'm the market maker and I sell it to you, I have to buy and sell shares of stock in order to hedge that, right? That's part of what I have to do as an entity, as part of my business operation. And so it's the trading of those underlying shares that can impact the market. So who holds the risk, right? Both from the initiator and the counterparty is really key to understanding here. And 90% of options are bought and sold by market makers, meaning 90% of the time, if you go trade, you're trading against a market maker. And they're really large, and there's not that many of them, right? There's only about 7, I would say, maybe 6 really large market makers, Citadel, Susquehannas, et cetera. So that is the transmission mechanism, right? The trading or hedging of the underlying shares that takes the options flows and brings it to be impactful to the underlying stocks that we're trading.
Yeah, on this next slide, it's important to understand this is not a static thing. Like,
right.
Once this hedging process is started, now prices are changing, time is passing, and these hedges have to be adjusted over time.
That's exactly right. So the minute you trade, let's say I have to buy 50 shares of stock to hedge your trade. Well, if the underlying stock moves, the delta or the hedge ratio changes just based on how the stock is moving. So I'd have to adjust my shares because of that. Also, if implied volatility goes up and down, so VIX goes up and down, I have to adjust my share count as well. And also, it's just as time passes. So if I'm hedged today, the stock doesn't move at all, but a couple days pass, I have to adjust my hedge ratio, right? So the hedging is constantly changing across a bunch of different dynamics.
And then on this next slide, this is why we do this on OPEX week, is we get to a point where a lot of this stuff expires, and that sort of changes the dynamics of all this. And it sometimes can be turning points for the market.
Yeah, and it seems like it's more often a turning point now, which is kind of interesting. We generally watch the third Friday as the biggest expiration cycle. And what happens there is positions build up on the third Friday of the month, and then the hedges associated with those positions build up. And then all of a sudden that OPEX, which in this case is on Friday, hits and positions are cleared out. And then oftentimes the trend in the market, both in terms of price trend as well as volatility, can change. And there's a whole bunch of evidence for this. Statistically shown that if VIX expiration is part of this OPEX window, so VIX expiration was Wednesday, which was yesterday as we record here on Thursday, that opens this OPEX window that's often talked about. And so there's statistical evidence that markets tend to shift, again, price. So if we're trending up, we tend to sell off, or vice versa, but also volatility, which is a critical thing to understand. So generally, if vol is spiking into OPEX, it tends to sell off after. Now that's interesting here because we have a relatively high volatility market, but it's tricky to say that vol is going to sell off here because of the Iran situation, which we're going to dig into.
This is really interesting. And this was a huge breakthrough for me, is when I realized that when people are buying all these options, that there's not necessarily someone on the other side of the trade that wants the other side of that position. And so you've got these dealers that are hedging all this risk. They have to manage the risk. Managing that risk implies buying and selling the underlying. And when they buy and sell the underlying, they can move the market. So it's just that whole dynamic is really interesting. And you see this in many situations. You see this in GameStop. You saw option dealers were certainly contributing very, a lot to that upward move when it was going on. They had to keep buying to hedge themselves. You see it in COVID with the top and the bottom. I mean, basically, remember we were all sitting here when COVID was it was out in Italy and the market's just not going down. And why is the market not going down? And then an options expiration cleared, the market tanks, and then the market bottoms again on another options expiration. So it's not that happens every time. It's that certainly was a contributing factor to when it topped and when it bottomed. And so I just think as an investor, it's really interesting to think about how this works and how it impacts what we're seeing in front of us every day.
Yeah, the whole idea of just understanding the derivative space next to reality, the underlying, whatever you want to call it, we can't separate them. They're too big. There's too much there. And the reality is if I buy or sell something directly with you, if we're bartering for something, if we're trading something directly, none of this matters. But in finance land, all this stuff matters because there is somebody out there with a derivative instrument who has no vested interest in the underlying, who's just trying to help somebody else go about their business. And that can help stuff really slosh in one direction or then the other in the short term as they reset that exposure. The idea of there's not always just another person with a slightly different methodology on the other end of your trade is a perfect way to just tell you how friggin' confusing and frustrating the markets can be if you're trying to do this.
And I'll throw this short in the podcast, but the idea is since COVID, the use of options has gone up dramatically. And so whatever you think the impact of this is, it should be a lot more now than it was back then. And I'll throw Brent's chart in where he shows this, but that's the idea. So I just think as an investor, although I've never traded an option in my life, I don't know if you have or not.
This is why you're a Jack Delta neutral forehand, right?
That's correct. Yeah, that's. Brent and I were joking this time. When I do it, we're going to do a live stream on the OPEX effect.
The
I'm
live
going to put on a. He was talking about put flies and stuff this week. I'm I don't even know what that is.
I want to see you start with the iron butterfly. That's all I want.
The iron condor.
Is
there an iron butterfly too? I don't even know.
I don't know. These are.
But whatever it is, we're going to come up with one of these complicated ones. We'll live stream Jack putting this on at some point when I do my first options trade. But back to the clips. You mentioned the awesome portfolio, Jared Dillian. Here's Jared explaining what that is.
The awesome portfolio is 20% each: stocks, bonds, cash, gold, and real estate. Okay. I came up with this idea in about 2018. I had this subscriber who lived in Idaho. He's a financial advisor in Idaho, and he's a very smart guy. I think he used to work at Lehman. And we were running some numbers on some different portfolios. And I was like, we'll try this, we'll try this, we'll try this. And he put together this portfolio that was 20% each: stocks, bonds, cash, gold, and real estate. And the Sharpe ratio on this thing was through the roof. And then you start looking at some of the numbers, what was I going to say? The average, the biggest drawdown for this portfolio in history is 12%. The second biggest is 9%, and that was during the financial crisis. The next three are 1%. So basically you have this thing that returns a little bit less than stocks. If stocks since 1971 have returned 11% a year, this returns about 9% a year. And it cuts your volatility in half, and it practically eliminates your drawdowns, right? And the whole philosophical reason for doing this is, basically we tell people, look, the key to investing success is to get an S&P 500 index fund, a dollar cost average it, and you can just do a future value of an annuity computation. And if you max out your 401k at 23,500 every year, and you put it into this S&P 500 index fund that returns 11%, you're going to have 16 million when you retire, right? And everybody believes these numbers. But the problem is that if you have a 40-year investing career, you're going to have 150% drawdown. You're going to have a bunch of 20% drawdowns. And unless you just have this bulletproof constitution, you are not going to be able to hold on during these drawdowns. And even if you don't necessarily liquidate, your behavior will change, right? You will invest more when it's going up. You will invest less when it's going down. You won't dollar cost average perfectly, and your returns will go down. So the reality is that this 11% return since 1971, nobody actually realizes this. So Vanguard, everybody does this in Vanguard. Vanguard knows that their own investors don't realize these returns because they're constantly trading their mutual funds. They're in and out, in and out, in and out into different stuff. And what they found was that if they added a person to the equation, an advisor, they call it advisor alpha, who just told them to stop trading their mutual funds and just hold, their returns went up by 3% a year. But you don't even have to do this. You can just invest in this awesome portfolio and it returns 9% a year with a virtually no drawdowns. And that's the solution.
As you know, I'm a huge fan of this, Matt. I'm a huge fan of the permanent portfolio. I'm a huge fan of derivations of the permanent portfolio. I'm a huge fan of this idea of there's different quadrants of what can happen economically. We didn't see the inflation quadrant or the two inflation quadrants for a long time. We are now, like, I think it's good to have something in your portfolio to handle all of those things. And the awesome portfolio does a good job of that.
This idea of you don't want to be, what's the Cullen? I think it's a Cullen Roche expression. Like you don't want to be like triple long GDP, or you don't want to be.
Yeah, you don't want to be like long the same thing 3 times or whatever. Yeah, I don't know if it's Cullen or not, but yeah, I know what you're saying.
Somebody's got the concept of like you're just making a giant like positive GDP bet, and maybe that's in justification for the 60-40. Clearly, I'm forgetting and shouldn't be making this point live, but that's the way this is going to go. But this idea of like different stuff works at different times, and I'm a fan of this too. And I think I pressed Jared a little bit on this, and he's discussed this too, where it's a big part when I have the advisor hat on and doing the planning work is like reminding people, like you have asset allocation, you have asset location, you have different stuff that you owned that's not on your financial balance sheet per se, where you're managing the risk, like the equity in your house. But we want to take or like the equity in your private business or the loan you gave somebody. Like there's all these different places these instruments show up. So when you start to divide your exposure in 5 ways, which is his variation, which is stocks, bonds, cash, gold as like your commodities buffer, and then real estate, it's like, well, you probably already have a lot of this stuff going on. You might have your stocks in your 401k or in your brokerage account. You might have some bonds, or you might just have like, cash in a high yield savings account. Parsing all these things out and understanding those different buckets and just saying the real lesson here is own a wide range so you can press rebalance. And then, hey, if you're dedicated to owning these ranges and these balance, when something is sucking, like it's been a miserable ride to do something like this for the 2010 to 2020-ish period. But it's like, if you had been accumulating gold and like topping your gold off through that, you're feeling pretty damn smart in the last like year or so. This enables that reinforced behavior of if like everything kind of goes up over time, it's a great framework to just make sure you're always eating your veggies.
And to your point about it sucking, like in the 2010 period, like these things are a double-edged sword. Like I do this for clients, so I'm a big fan of this type of approach, not the awesome portfolio, but something very similar to that. So the positives of this is what Jared said, which is your drawdowns are much lower with something like this because you're dealing with all the potential outcomes and your returns are more consistent with something like this. The downside is the market's ripping for a decade. You're going to trail by a lot. And as people, it's very, very hard. Jim O'Shaughnessy talks about this as the second point of failure. In a lot of ways, that's harder. It's harder to trail your peers than it is to lose money. And so you have to be one of these people who is not concerned about that to follow this type of portfolio just because it's going to look really different.
Yeah. Which is why all I trade are 0 DTE options. And
well, that's going to look really different, Matt, if you're your 0 DTE strategy.
Yeah. No, I am also very delta neutral by means of 0 exposure to it.
I can tell you, if I did one, it would look like this. It would basically be just losing money constantly until I didn't have any left. So, which is why I don't have a 0 DTE strategy.
Fans of diversification. That's a big thing I know we both agree with, because more things can happen than will happen. So why not just admit that you don't know and expose yourself to some assets that can appreciate under some of those various environments, and that you can walk away from however you, the world, or whatever gets torched. You want to be able to fight another day. Huge fan of this. I'm really excited. Jared's new book on this is coming out, I think in September, he said. And I'm really happy that he's decided to like focus an entire work just on this topic, because even as a benchmarking or a logical exercise, I think this is just tremendously useful.
So one of the interesting things about Brent's work is this idea of, we'll talk about what gamma is in a second, but this idea of if we can look in aggregate at what all these option dealers are doing, it can kind of tell us, like, if we get volatility, are they going to make it less? Are they going to make it worse? Like, what are they going to do? And so here's Brent talking about that.
And so the gamma index is measured every night, and then it forecasts the next day volatility. And what you see here is the lower we go in this gamma index, which is referred to as kind of negative gamma, then forward 1 day volatility tends to be higher. There's some evidence that this also is on larger time frames. So basically what we're saying here is that the SPX index gamma is negative, and then that is going to drive price, right? That's going to drive markets lower, because if the market goes lower, market makers have to sell stocks. And if the market rallies, they got to buy stock. And when they're doing that, they're pushing the market as the market trends in a certain direction. And so that can really exacerbate volatility in a significant way.
So I know in past times when this has been to the left and we've had high predicted volatility, when OPEX cleared, it actually went to the right here. Is that what you expect here, or is this a different situation?
This is a different situation, because normally what would happen is if we were crashing into an options expiration, you may sell your puts, right, Jack, and then say, okay, like, risk is kind of over. We're sort of clearing. We had a nice sell-off. I'm going to close these puts up. In this situation, you can't afford to not be hedged because of, to the point of the title here, right, of the presentation, the known unknowns. The known unknown is the Iran situation. We all know that the Iran situation is not going very well right now. And you can't hedge that with a short-term option, right? You need to own a 1 month, 2 month, 3 month, whatever, put or VIX call or whatever it is to hedge yourself. Same thing with the credit market. Credit market's getting a little weird right now, right? We don't know if something could break. It's a known that something could break. We don't know what it would be. So we have to hedge that. You can't hedge that with the short-term option. So what does that mean? Yes, we're going to lose a bunch of put protection here at OPEX and with VIXX, but you have to roll that to a new position. You can't sort of afford to sort of let that protection lapse. And so I think that keeps the pressure on in a unique way in this case. And so what does that mean? Now we have the market sort of crashing-ish, right? It's sort of like to the point of what we were talking about before. It's like it feels like it should break, but it's not. And I think it's the positioning that's been holding it in there. And if that positioning sort of wears away or moves away, then maybe realized volatility could really start to spike. In other words, instead of having, if you look at the data, we have about 12% realized vol over the last month, right? That equates to about 75 basis points of movement in the S&P every day. Well, the average in the S&P is like 68 basis points over time. So we're just moving at a very average amount. If we have a 2-3% sell-off, that's like 30% realized vol, right? That's a big spike. And that would mean that the VIX or implied volatility would spike in kind. So then we start talking about, hey, if we get 1 or 2 sell-offs is about 2%, then I suddenly think you see the VIX go to like 35 or 40, kind of like that. That's the jump risk that I'm talking about. And that's, I think, the risk in this market at this moment.
So we've talked in the past about people using zero DTE a lot. I would assume, like you said before, like with something like this, you're going to see people using longer term options for hedging, right? And you'll see that reflected, I would assume, in the VIX going up, right?
Yeah, and I've seen anecdotal evidence of zero DTE volume and the flow subsiding when these known unknowns come up. And that's to your point, Jack, because you can't hedge a Iran situation or a possible credit event when you don't know the timing of that event. You can't hedge that with the zero DTE. Now you can make the argument like, well, market open today, nothing really accelerated in Iran. So for the rest of the day, I'm okay. So you can trade some zero DTE. But what I've seen, again, anecdotally, because there's not a ton of data around this, that when you get these unknown events, like a bank crisis, a credit crisis, a war situation like this, a hot war situation like this, zero DTEs back away. And it becomes more about hedging, to your point about 1 month, 2 month, 3 month options, owning some volatility that can cover you on a day-to-day basis as opposed to intraday.
So I won't have to define all my options terms here, Matt. Hopefully you won't ask me to. But the idea, I think, like in aggregate, are dealers long gamma or are they short gamma? And the idea is we'll just define it really quickly. Like delta is how much your option position moves when the stock moves, and gamma is how much delta changes when the stock moves. And so it's like a second order effect. But the idea is you can get these charts like over the internet. And Spot Gamma has one. Like this idea of gamma exposure. And what gamma exposure tells us is if dealers are long gamma, they're likely to suppress volatility. If the stock market starts to go up, they're likely to sell into it. When dealers are short gamma, they're likely to exacerbate volatility. And so you saw in that chart Brent showed, we were pretty far to the left on that chart, which means we're more towards that short gamma thing. So we're in a situation where dealers could exacerbate volatility if we went down.
This idea of what Brent says he can see is like, it feels like something should break, but it hasn't broken yet. I feel like it's watching those awful internet videos where it's like a bunch of people are, usually they're like getting on a boat or something that shouldn't float, but they're treating it like it's going to float. And like, the tipping point, the comedy value is coming before it happens. But like I just saw one of like a bunch of like, drunk people getting onto like a picnic table on something, like in the body of water. And you're like, I know how this is going to end, but I have to watch this now. It kind of feels like that. You're like, I know this isn't going to work out. And if it does, it's like a minor miracle, but the odds are stacked against everybody getting wet. When I hear Brent talk about it, this is kind of what I envision. Somebody who's trained to see these things anticipates a bad outcome is now more likely to happen in the very, very short term with like larger scale impacts. Is that a fair way to?
Yeah, that's right. And I think likely is a key word here, because like these options guys always think in probabilities. Like they always think about like there's this probability on this side, there's this probability on the other side. And so Brent kind of feels like where we are right now, he doesn't think we're going to have a COVID situation, but he sees parallels from that in terms of what I've referenced before, which is this idea that the market was kind of staying up and we're like, all this stuff's going wrong around us and the market's staying up. Like he sees the potential when this options expiration clears here that we could have some negative stuff associated with that. Obviously, we don't have the economic event of COVID. I mean, this is oil pricing going up in a war. It's bad, obviously, economically, but it's not like what that was. I mean, that was the entire world economy getting shut down. So it's not that bad, but it's good for me just in the back of my mind to have this kind of stuff. And I always find it interesting to see when Brent's seeing something behind the scenes, like going into that recording, I didn't really know where he was at. Like because I can't see the stuff he sees, but like I come out of it thinking, all right, this could be a situation where, when we do clear this options expiration, the probabilities could be higher that we have a downside event.
And I always think about this when I'm listening to Brent too, because on one hand, it's the way this adjusts might be just 2 bad days for stocks. And for long-term investors or whatever, we're like, 2 bad days? Like, come on. We got our, 15% average annual drawdown intra-year. Like we're expecting more than like 2 bad days at some point over the course of this year, let alone like over the course of this day, week, or month. But the part, and it's inside of that COVID comment, which agreed that we're not in that type of a scenario, but it's also when Brent puts something like this is one of the earlier dominoes in every bad event and every good event on the recovery too. We're like, these are the things that happened first, because something like this happens in a response. You get a giant blow up in VIX. Well, now everything that's like volatility based rebalancing or like driven by some of this stuff is going to respond to some of these like other triggers. And it's that first or second or third domino falling in like a larger sequence. He's not predicting that it's going to carry all the way through, but these are almost like earlier leading indicators of greater things. And that's why you want to keep your finger on this pulse.
Yeah, the options are not the events, but they affect the timing. And that's kind of the way I look at it, is like the event obviously is there's a war going on, but the flows behind the scenes and the way people are positioning themselves can impact how that plays out in the stock market. And so I think it's just really interesting. Like I always love doing those OPEX effects just because I learned so much about that.
Yeah, same. Really, really appreciate Brent's work on this stuff. You ready to take it back to DA? I think we're ending on.
Yeah, we're wrapping it up here with DA. And this is really interesting because biotech it's doing better now, but it had a long period where it didn't work. And he was talking about this idea. This struck me when I originally edited your interview, this idea of competition for capital and AI. So here's him talking about that.
Within the public markets, biotech is competing with all the other risky sectors for investor interest. And so I think what we saw was that for a couple of years there, most of the hedge funds and a lot of bigger generalist allocators of capital decided that biotech was just not an area they wanted to be in. They wanted to do other stuff during that period. And in particular, sort of big tech and the AI narrative created a competitor to biotech for that risk capital. So money flowed out of the biotech sector into other parts of the market. And that just created a massive headwind for all of these companies. So during that period, you had going on what typically sort of drives this sector, which is you had companies doing clinical trials, sometimes getting acquired by large pharma companies. These are the things that drive returns, but those returns were occurring against a backdrop of money being sucked out of the sector. And so it was like all the prices were going down together, and only if you were extremely careful and specific with your bets would you find these little instances where you could make money. And of course, what we hope for the rest of the time in more normal environments is that there should be hopefully kind of like a steady state risk premium of some kind to investing in biotech. In other words, you would hope that it's sort of a good place to always have some money. And then if you're good, you would generate returns, far in excess of that by doing the kind of specialist investing that we talked about. On the other hand, this is, as we're describing it, a market that goes through cycles. And so, it was just definitively a bad place to be for the past few years. And we came out of that. Starting about halfway through 2025, there was this massive resurgence of risky biotech investing, capital flowing back into the sector, and you saw returns even in the sort of passive biotech indexes of 80, 90, 100%.
Did you study, and this goes back to like the post-COVID era and doing work with pensions and the hurdles rates and the stuff like that, thinking beyond the 60-40 at that time. One of the most useful things I think I learned, like really felt like I understood at that point, was this preferred habitat theory, which is like a whole bond. It's usually used in bond land. Do you remember this? Does this ring a bell to you? It's basically the idea that it's the match between, I want to say, like duration preferences and risk preferences, usually for fixed income. So it's like different people exist at different parts of the duration and the risk curve in fixed income. So it's like if you have pension investors who are going to go around a certain place, they're going to look at like a maturity and a credit quality of bonds. And it's like, oh, I need to own these bonds for paying out these claims in this period of time, or these liabilities in this period of time. So the asset liability matching that goes across these curves makes a difference of like who's where. And it's the same thing that describes, like, there's these high yield fund managers, for example, who will be like, oh, we only do ultra short duration high yield, but basically have a like short and intermediate duration high yield fund. When they're like, oh, we're under 2 years, we can't hold this anymore because it's not part of our mandate. They buy from them. They make a couple of pennies when they buy from them. They hold the maturity. Nobody else wants to hold it till the bond matures because the math gets wonky. Then it's like, oh, you could pick up an extra couple bucks if you just understand you live here and you don't live there. What he's describing is now a version of that, but like with growth investors, where it's like, and it's weird to think about, but it's like if you are looking for speculative or high growth or these lottery ticket opportunities, you're looking at venture, you're looking at these different areas, and biotech kind of fits in there. That's kind of why tech is in the name. It's like these growth opportunities are hard to price options, far away things, no revenue to base them on. But when something like AI appears, it's like, well, forget all those crazy lottery tickets. I want these less crazy feeling in the moment lottery tickets. It's a different preferred habitat for growth. And that's contributed to this like serial underperformance and this serial like underfunding of a lot of these projects. I hadn't really thought about how preferred habitat theory applies in places like the ultra risky equity markets before. And
yeah, I have. It happens everywhere. And that was the same thing for me. Like I didn't think about like the whole venture capital, high risk area. And like, obviously if AI comes on the scene and AI is this new huge thing, AI is going to benefit biotech in the long run because they're going to use it. But in the short run, everybody's like, I need to put money in AI. And so that money's got, capital's finite. That money's coming out of something else if it's going in AI. I thought that was a really interesting like way to look at this. And just, I'll look at this differently going forward because of that.
Same. Capital is going to go to the ideas that suit it. It's going to go to the profiles of the people who are making those decisions, the risk profiles, the preferences, what they want and why. And it's really interesting to think about some of these hyper specialized areas where there's a general person who's like on or off, and then there's a specialist who's always operating there. And it adds a different layer to the manager selection question too, that I think is really, really useful when you're considering where do you want to be active versus where do you want to be passive and why. This was maybe the best articulation of that I've heard since some like ZERP era bond fund managers explained like, oh, wait, let me explain who my neighbors are before I'll tell you exactly who we buy and sell from and why, and where we can earn a couple of extra bucks doing this process. I hadn't really understood that in the ultra high growth space or even thought about how they're competing for angel and VC dollars in some of these scenarios.
So I think this is a great combination of clips to deal with the world we're in today. Like we've got a lot of uncertainty. We thought about it from the macro perspective. We thought about it from the options perspective, and then we got ourselves away from that a little bit to think about something maybe more of an evergreen thing we can think about. So yeah, it was fun doing this, Matt, and I'll let you bring us out because you're the pro.
I love doing these recap shows. I love revisiting these ideas. Make sure you head over to Substack too. We've got the Substack up. We're deriving lessons from all these posts. We're putting those there. I think we're doing some really cool stuff, honestly, with the Substack. So excess returns on Substack. Hit us up over there. But in the meantime, let us know what you think. Subscribe if you haven't already. Press that little like button. Leave a comment below. Jack, let's do this again next week.
We will. We'll be here. We got some great guests next week. We won't say who they are yet, but we've got some great guests. So we'll see you next time, Matt.
See you next time.
Thank you for tuning into this episode. If you found this discussion interesting and valuable, please subscribe on your favorite audio platform or on YouTube. You can also follow all the podcasts in the Excess Returns Network at excessreturnspod.com. If you have any feedback or questions, you can contact us at excessreturnspod@gmail.com.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of the firms of the hosts or their clients.